We would like to welcome you all to this webinar that is organized by CAF, the Development Bank of Latin America, and FLAR, Latin American Reserve Fund, on recent developments and inflation outlook in Latin America, central bank technicians' views. Over the past years, the number one challenge for the world's and our region's macroeconomic stability has been inflation control. Its fallout has been widespread not only because it has created uncertainty for consumption and investment purposes, but also because it reduces the allocation of resources affecting the most vulnerable population in society. Inflation has been growing markedly in a varied context, reaching unprecedented levels over the past decade. Fortunately, as of this year, it has begun to come down in different countries, but this battle is not won yet. We still have to do many things to reduce inflation rates in the region. In order to talk about policies and inflation rate outlooks in the region, we have four keynote speakers representing different central banks, the Central Bank of Peru, Chile, Mexico, and of the Republic of Colombia, respectively. All these banks have very sound technical departments that support decision-making for their authorities. Thank you very much for attending this webinar. I would like to extend my appreciation to Alejandrina Salcedo, General Director of Economic Research at Banco de Mexico, Elias Albagli, Director of the Monetary Policy Division of the Central Bank of Chile and Chief Economist, Hernando Vargas, Technical Deputy Governor at Banco de la República, and Adrián Armas, Central Manager of Economic Studies at the Central Bank of Peru. They will be sharing their personal opinion with us, and their opinions do not reflect necessarily the opinion of their boards. For the purposes of this webinar, we are going to have two rounds of participation. Adriana Ariasa, who is the manager of macroeconomic studies at CAF, and myself, we will be the moderators. It's always a big pleasure to jointly organize this event with CAF and Adena specifically. We work closely together in order to promote macroeconomic stability and development across the region. So let us start with the first keynote speaker of this panel. We would like to hear each one of them talking about the recent monetary policy measures and inflation rate evolution in the region, taking into account global and local aspects concerning inflation rates, taking into account supply and demand as well, and the relevance of the salary and contract indexation mechanisms, the effects of monetary policies, and the outlook of inflation rates as a key factor in order to control. In order to start, we are going to hear Alejandrina Salcedo, who is the General Director of Economic Research at Banco de Mexico, pricing analyst in this same institution. She was also responsible for the Secretariat of Public Credit. I would like to thank Alejandrina for joining us today. So Alejandrina, you now have the floor in order to give us your opinion about the current scenario in Mexico. First off, thank you very much for having me. I'm very pleased to be here in order to share with you our opinion about inflation and the challenges ahead. So let me start by some slides to support my presentation. Let me go back to what you mentioned before. There was a very sharp shock. I believe that this can be summarized into three characteristics. These shocks have been very profound. They are quite unprecedented. They are widespread shocks, which means that they have disrupted the economy completely across sectors, across goods and services that can be found on our price index. And they have also been long-lasting. The pandemic started 3 years ago, but we can say that these shocks still remain lingering. Besides, these shocks were further exacerbated as a result of the Ukrainian war and pressure on international food prices. In the particular case of Mexico, this had a particular impact. This is the evolution of interest rates over the past years. In Mexico, inflation reached 8.70 in September 2022. And as you said before, now we are going through an inflation slowdown process. So the latest inflation rate stands at 4.32% as to based on the data in the second fortnight of November. But let us talk about core inflation that shows inflation more accurately. In this case, it has been growing for 24 months running. These were very complex months, and there was a lot of concern around inflation behavior. It reached 8.51% in November 2022. Thereafter, there has been a decrease, and right now it stands at 11.31%. Now, this 5.31% vis-a-vis 8.51% shows all the pathway that we have gone along in reducing inflation. We have made steady progress, but we still have many challenges ahead. 5.31% for this trend indicator remains quite high, taking into account that our target inflation rate stands at 3% for the Central Bank of Mexico. Then we have the non-core inflation that has reached two-digit levels for many months, about 10%, with a subsequent fast reduction reaching even negative levels. We had not seen negative levels before, except for those reported prior to the pandemic. All the same, these are historically low levels that have contributed to the decrease of headline inflation. There has been some kind of reversal as well, which is quite logical due to volatility, but all the same, it remains atypically low. Noteworthy is the component that makes up core inflation. In this case, we see goods behavior, which have been under plenty of pressure since the outbreak of the pandemic, and this was compounded by the war in Ukraine with two-digit inflation rates affecting goods. But this has been reversed somehow due to the pronounced clash between supply and demand. There was a change in the composition of household expenditure. People began to spend differently. There was also tax stimulus coming from advanced economies. Now, this trend has been reversed due to the new monetary policies. In Mexico, there has been a significant national currency depreciation as well. Now, talking about services, we see some reduction due to this clash and due to the effects of these shocks. And even though inflation regarding services does not continue to grow, but it's not coming down either. And this is something that we have observed at the Central Bank of Mexico. We believe that perhaps they have also been affected by the pandemic shocks and the Ukraine war. Perhaps demand was not dynamic enough yet in order to pass this through to consumers, creating a persistent situation and creating persistent core inflation. In this context, the Central Bank of Mexico took some measures faster than other central banks, increasing interest rates since June 2021. Increases were carried out for 15 months running, reaching 11.25% as part of the monetary policy that was implemented as of March 2023. Since then, the board decided to keep it at 11.25% in being worried about consolidating the current disinflationary process we are undergoing. long-term inflation expectations have remained anchored throughout this period as a result of this credibility that the central bank has been able to earn itself for many years, and due to the commitment undertaken by its board during this complex background. Let me stop here. Thank you very much for your attention. Thank you very much, Alejandrina, for starting off this presentation. This is the Mexican experience. It's very interesting. And as you said before, great work was carried out in order to curb inflation and in order to provide more credibility to the economy for stakeholders. This has translated into a downturn in terms of inflation over the past years. The world has been affected both on the supply and demand side. Among other circumstances. Very good. Next, we are going to travel to the south of our region, and I'm going to give the floor to Elias Albagli. I hope that your connectivity works properly. Elias is the director of the Monetary Policy Division at the Central Bank of Chile and chief economist. He was also a manager of economic research, senior economist, and analyst economist. Thank you very much, Elias, for attending this webinar, and you have the floor now. Thank you very much. Can you all hear me, Carlos? Yes, we can. Thank you. Okay. I would like to make some comments about the questions that have been raised. There were some supply shocks affecting countries, and there was also an increase in goods prices as well as supply chain disruptions. All that happened during the pandemic. That was compounded by high international demand, something that we should not lose sight of. Inflation was controlled by inside factors, at least as far as Chile is concerned. And we should highlight liquidity outflows going to Chilean households, as well as through government transfers and through pension funds, reaching 30% over the country's GDP within 1 year and a half, approximately between 2020 and 2021. Therefore, we are talking about a liquidity shock that was unprecedented in Chile. Against this background, the Central Bank of Chile began to hike rates quite early in June 2021, even though we were fulfilling our target inflation rate of 3%. And the reason why we did so was because since we have a monetary policy framework whereby we like to do inflation forecasting for the next 2 years, our target rate is 3% for the next 2 years, not for the current period. So all forecasting models always tell you that inflation rates are going to go up considerably. There was no doubt whatsoever that this was going to happen, even though sometimes we don't know how far. So we began raising rates prior to inflation reaching such levels. That was quite criticized at the beginning because people need to see higher inflation rates in order to understand the central bank's decisions. But we didn't have to wait much. After a few months, inflation rates even exceeded our own projections and forecasts. Despite hiking rates, GDP grew by 22% in 2021 and private consumption by 20% in the same year. In addition, the Chilean peso depreciated more than 20% during 2022. All this in a highly uncertain political context. So we're talking about high demand, the monetary policy, and a huge foreign exchange spread. all this pushed inflation to 14%, whereas the core inflation rate was 11%. As I said before, this is directly tied to demand. All this led to changing our target inflation rates for the next 2 years, not only for financial analysts and enterprises, but also to individuals. So we are still working on gathering some final data. So we implemented the highest interest rate hikes ever, from 0.01% in June 2021 up to 11.25% in October 2021. So the average is 100 basis points. Sometimes we implemented increases of 50 basis points. We have also been doing some fiscal consolidation in curbing inflation. So all this led to an economic downturn. Reducing inflation is mainly attributed to consumption shrinkage as well as activity shrinkage. So since the beginning of 2022, this activity has been shrinking on a quarterly basis. This did not happen by chance. And as a result of this drop in consumption, inflation has come down as well. Now, inflation has also fallen in other places. So how can we tell that this is due to our monetary policy measures? Well, there are some reasons for that. In Chile, we have not only cut down inflation on goods, on volatile products, but also inflation on services. And the reason is that the unemployment rate has gone up to 2%. In the past, it had reached 9%, and our reference rate is 7% approximately. So there's plenty of labor. Then this shows that the economy cooled as a result of interest rate hikes. As a result, inflation fell. So it went down from 14 to 5% in the case of headline inflation, and core inflation came down to 6.5% since our latest report in October. I believe that you also asked about salaries. For example, if you take into account real salaries remain 3 or 4% below pre-pandemic levels, even though there was a slight increase in the minimum salary level. So despite this fact and high inflation, we did not apply any salary indexation. Of course, we were worried about that for quite some time, but we didn't see such indexation taking place. In real terms, we can say that salary levels remain below this trend. So consumption, the market labor activity, those are the fundamentals of inflation. So the central bank decided to start decreasing inflation interest rates, first by 100 basis points, then by 50 basis points. So we stand at 225% right now. The rate stands at 9%, and we expect new reductions in the coming year. That is the foreign guidance that we have provided as well. I believe that I should stop here, right? Thank you. Thank you very much, Elias, for your presentation, for sharing the Chilean example with us. No doubt, several inside factors contributed to reducing the inflation rate. For example, liquidity. And there were also some tensions in the political arena that have also triggered off the some changes in the country's monetary policy. Fortunately, right now you are back on track, and medium-term expectations based on the indicators you have reported remain within the uh, range or the target set by the Central Bank of Chile. You have a very specific target as far as inflation is concerned. Okay, now we are going to give the floor to Hernando Vargas, Technical Deputy Governor at Banco de la República of Colombia. Before that, he was responsible for economic research. He was also director of macroeconomic studies in this institution. He worked at this bank going through many situations of inflationary pressure. Therefore, he will talk about some of the monetary policies that have been implemented in Colombia over the past years. Thank you very much, Hernando, for joining us today. You have the floor. Thank you very much, Carlos. I would also like to thank CAF for this invitation. In the case of Colombia, inflation was pushed by foreign demand as well as by inside demand and loss of FX pressure, perhaps much more than in other regions. As for internal factors, they came mainly from the products side. Several production sectors had some issues due to social turmoils and also due to the effects of the La Nina phenomenon. So there were several shocks, assorted shocks that happened in a context of high demand levels. And there was, on the other hand, a big expansionary monetary policy that also put pressure on credit. This context also was also affected by other pressures such as social disruptions in 2021, elections in 2022, and also the new economic and political approach of the new administration. Prices went up in Colombia more than in any other region or any other country in the region. Our currency was depreciated by 20% in 2022, whereas other currencies remained stable. The GDP gap was over 2% in 2022, and foreign deficit was more than 6% over GDP in 2022, even though there was an economic book in other sectors. However, in Colombia, we didn't see high inflation until mid-2022 as a result of fuel prices that remained stable and subsidized. Despite high international oil prices in 2023, inflation came down due to the domestic price of fuels. This price, the gas prices rose to 48% over the past year. This also affected Colombia. And then there were, in Colombia, price indexation is very important. This is reflected in salaries, in consumer price indexes, and in the indexation of other prices and regulated prices. So as a result, we were not able to reach the 3% target inflation rate. In this context, the monetary policy became ever harder. The situation has led to some shocks on the supply side, and we are still far from reaching the target inflation rate of 3%, because right now inflation stands at 13%. The interest rate went from 1.75% in 2021 to 13.21% this year. So if we take into account ex-post inflation, these are the expectations. The economy has slowed down over 2023 due to some macroeconomic adjustments, not only monetary adjustments. This year, there has been a decrease of 2% virtually over GDP. Against this background, we believe that the economy will grow by 1% this year, whereas it grew by 8% in 2021 and 3% in 2021. So there are still some clear-cut demand effects in this regard. We do not face a monetary policy trade-off. There has been a big dispersion or difference as to spending across sectors. Therefore, this 1% increase somehow hides a significant sector variance. There have been annual drops, and several service providers remain quite strong. As for expenditure, it remains quite sound. So let me stop here if you agree. The interpreter apologizes, but unfortunately the speaker sound has broken up constantly. So as you are saying, up until now, the situation in Colombia has been quite challenging. There are several inside aspects concerning both supply and demand. You spoke about some halts that have occurred over the past years, leading to some monetary measures in order to tackle this context. But now there are some positive signs in order to control inflation as a result of the monetary policy that has been implemented, with a reduction in GDP growth, but this is also the outcome of lower fiscal deficit. So thank you very much. Next, let me give the floor to Adrián Armas, who will close off the first round of participation. He's Central Manager of Economic Studies at the Central Bank of Peru. He had different positions at the central bank in the past. Like his colleagues, he was an official in this institution. He was manager of economic research. He was also involved in the financial analysis department at the central bank. Thank you very much, Adrián, for being here with us and for sharing the Peruvian experience with us. So you have the floor now. Thank you very much, Adriana and Carlos. I truly enjoy these webinars because they enable us to exchange our experiences. Mexico, Colombia, and Chile have a target inflation rate of 3%, with a range between 2 and 4. In the case of Peru, it's 2%. So what we can say before we touch upon any details, in our countries, this inflation scheme has worked quite well. And this scheme has gone through very different stress tests. All this began with the COVID-19 pandemic, to be followed by unprecedented inflation rates worldwide. In the particular case of Peru, if I were to compare Peru with other countries, I would say that here we had more supply shocks that have fueled inflation expectations. We didn't see significant inflationary pressure in the Peruvian economy. In fact, Peru, as shown in the graph, over the period, even from the very onset, and I'm talking about mid 2021 when international inflation rates went up, this inflation rate remains stable. Therefore, inflation of the peak was reached in June last year, standing at 8.8%. In the United States, they picked the inflation rate in June, standing at 9.1%. So we have observed some stabilization or persistence in price corrections. The graph shows that core inflation was above headline inflation or total inflation. So there was no significant adjustment to food prices. We can see that, or we have seen that over the past months, however. Now, if we move to the next slide, you can see the monetary policy interest rate approach in Latin America. In the region, and based on our experience and as central banks, we never underestimate inflation, and that's why the region as a whole has always increased interest rates as part of their monetary policy. In all cases, we have been able to reach record rates. In our case, our starting point was 0.25%. The first adjustment took place in August 2021, standing at 0.5%. And since then, we have been growing at 50 basis points until September last year, when the pace slowed down to 25 basis points, the last increase taking place in January. So this rate evolution is correlated to the evolution of inflation. As a matter of fact, in Peru, this year, this figure stands in a negative area. In Peru, the political context was particularly significant in 2021, and there were many short-term capital outflows, the greatest since we have data available dating back to 1950. So 2021 was even more difficult than the situation we experienced in the 80s and the 90s, reaching record highs in terms of outflows. Regarding the monetary policy rate, it's now going down. And after a break in September, the interest rate has been coming down from 7% to the current rate. As far as inflation is concerned, this is good news. Now the year-on-year rate that was 4.3 now stands at 3.6. So that is good news according to the latest data published. The risk we face has to do with the shocks coming from the supply side as a result of the El Niño phenomenon, something that we are monitoring closely. You mentioned that yourself, Carlos. There's very good news in terms of our fight against inflation, but we cannot say that we have won this battle yet. Let me stop here. Thank you very much, Adrian, for your clear presentation. In fact, you had to go through a very tough local scenario, taking into account the political scenario and also the price context and the clash between supply and demand that is becoming a complex factor when it comes to making decisions. So we are closing the first round of participation. So let me draw some key conclusions. As you said, Adrian, there's some common ground among the region's central banks in order to manage a good inflation scheme. Central banks across the region and in general terms somehow followed a similar approach in a highly complex scenario where we have seen all kinds of clashes, but there's no doubt that some progress has been made through uh, throughout this period. You also mentioned the clash between supply and demand. And demand has been particularly intense in some uh, countries. It's true that we still have to continue curbing inflation rates further. So, in the second round, we are going to discuss this further. So, now let me turn to Adriana, who will moderate the second panel. Thank you very much, Carlos. I'm delighted to participate at this very interesting event that we have been hosting for several years by now. In fact, and as you said before, significant progress has been made in fighting against inflation. And in this regard, monetary soundness has been critical, as well as the policy mix that our keynote speakers have mentioned, as fiscal stimulus has been withdrawn, and that has led to the cooling of demand in countries such as Chile, where clashes coming from demand were important. As Adrian also mentioned, it's still early, however, to say that we have won this fight against inflation. So now I would like to ask our panelists or speakers to talk about our outlook regarding inflation in the short and medium term, and which foreign and domestic factors are of particular concern to them or that might be affecting our capacity to control inflation, not only internally, but also in the current foreign scenario. So let us start with Colombia first, Hernando. Well, in Colombia, inflation has been coming down for 7 months running due to the depreciation of the Colombian peso and due to demand adjustments. Because Colombia has done this more slowly than other countries due to fuel prices, this year we believe that inflation will end between 9 to 10%, which is still well above our target. In 2024, we expect that inflation rates will go down considerably. There has been a relative stable FX rate that has contributed to these dynamics. The El Niño phenomenon caused droughts in Colombia, affecting food prices and energy prices, water energy prices specifically, whereas salary indexation or adjustments in Colombia, this salary is relatively high and this can affect the prices of services. As for external conditions, they will always affect our interest rates and FX rates. Against this background, monetary policy have to make sure that we reach our targets while trying to speed up our economic rally. So now we have to promote growth, employment. The Central Bank of Colombia will therefore have to reduce interest rates in order to meet our target inflation rates. And this will perhaps be the most important disinflation process for the country in the past years. As Carlos said, reaching the 2% inflation rate target will be quite challenging. But this will happen only once we have no more clashes between supply and demand. So at that moment, we will be able to ease up our monetary policy further. Over the past 3 years, and I fully agree with Adrian, we have learned that our strategy has worked quite well despite uncertainty due to the pandemic and post-pandemic scenario. FX pressure, at least in our case, is the best way to absorb real external financial shocks, and it's a good way to keep the buffers we need for the economy to work properly. That's one of the main challenges of our monetary policy. The current world is going through significant economic and political changes that will perhaps heighten some of the shocks affecting our economies. In order to mitigate these fallout effects, we need to have a credible monetary policy. We need to have low public debt. For example, FX rates are more volatile when the economy is not very sound, or the pass-through of FX rates, or the clashes of supply and demand are lower the more credible our target inflation rates are. So this will somehow determine how we deal with current clashes and the ones to come. But people should believe that central banks can eventually control inflation rates. And of course, we'll have to wait and see what happens with public borrowings in the future in our region. Thank you very much, Hernando. So the combination of policies is one of the challenges ahead, because if fiscal policies are not well guided or have a clear-cut trajectory in order to render debt credible, the monetary policy related work becomes more complex. And in times of economic weakness, that can trigger off increased pressure that might prevent central bankers to travel the last mile, which is always the most difficult part. Let us now move to Elias so he can speak about the future of inflation rates in Chile. You reached a one-digit inflation rate, and you believe that you will be below 0.5% according to your outlooks. So could you please let us know, Elias, which is the main challenge that you envisage in Chile going forward? Okay, first off, based on the monetary policy report released in September, we have not changed our projections significantly for the next report that will be released in 20 days' time. However, we have a 3% rate. That was the rate that we reported in the prior report, and that is the current rate. As Carlos said, and sorry, I forgot to mention this, inflation rate expectations for enterprises, households, and the markets has been re-anchored, so to speak. We have high frequency reports every day. It already stands at 3% for the next 2 years, and that figure has remained so for the past months. Short-term inflation rate expectations have also come down. So what about our baseline scenario? We are nearing that 3% in closing the last quarter of this year. So activity has come back to normal, and we do not see major risks in terms of inflation convergence due to domestic reasons. We do not expect many surprises coming from that front. But there are other significant risks coming from the outside front. And let me highlight some challenges. There is a mismatch, a cyclical political, monetary policy mismatch. In the particular case of Chile, and let me give you a hypothetical example. Let's suppose that we have this scenario of monetary policy where we have more sensitivity, more weakness in the economy, and we have to cut rates even further. Financial markets are extremely sensitive to rates. They're all looking to the United States. They're all looking to what countries might do internally. So I don't think that this is a risk to inflation as such. If we had to cut rates faster. However, I think that this might be an issue because it might trigger volatility in the financial markets. In Chile, that happened when we began cutting rates. Back in July, we cut rates faster than what the market expected. The Fed, on the other hand, was sending signals in the opposite direction. So pressure went up, there was a lot of volatility, and there were also certain threats because that volatility could have fallout effects on other financial markets. So that is one of the most important challenges, financial volatility, and not so much inflation convergence, but I think that there might be financial risk and volatility. Another challenge is that we don't yet know why long-term international rates climbed so much over the past months. In some cases, they shot through the roof to 100%. That is something that we had not factored in. So why did that happen? There are different hypotheses. We might assume that this is a cyclical situation that has to do with Fed's solutions for the interest rate for longer scenario, etc. I think that it's a cyclical reason. But then we might have another answer, and that is that this situation might be reflecting a long-term rates that might remain high for longer. So we can draw some conclusions. The positive conclusion is that investments will grow. There will be a greater potential growth. So that would be the upside. But the downside or the negative interpretation of all this is that we have a fiscal problem. There's a fiscal issue in the United States, and the market is now beginning to awaken to the fact, well, the US Congress is ever more dysfunctional. They have built up their debt stock quite significantly. And this is like a competitor movie, they have not included the climate change effects, etc. So fiscal deficit in the United States may close at 8 or 9% in the next years. So in the current rate scenario, such deficit would lead us to a very poor balance between debt and interest rates. That is no doubt a negative effect of risk premiums that will subdue the activity and will worsen the FX scenario in the region. If you now allow me, I would like to share with you one of the lessons learned from this scenario. And this dovetails to what Hernando mentioned before. I think that we've learned that the monetary policy framework we have in Latin America does work, but you have to monitor such a framework. If you have a framework but you don't monitor it, it does not work. I would like to underscore the word framework because other countries' frameworks are not so clear. And let me go back to the United States. The United States had a very confusing monetary policy framework that was quite ambiguous, and they rendered it even more ambiguous. I don't know whether there's anybody here who can explain to me what inflation targeting means. It means to have a 2% average rate, but within which timeline? They are going to focus on employment shortfalls. I don't really know what they mean by employment shortfalls. If we ask members of the Fed about that concept, they will all provide a different answer. There was a so their monetary policy became even more ambiguous before inflation shocks transpired, and that shows why monetary policies in advanced economies came in later. So I believe that this is one of the takeaways. Our frameworks are good, they work, but we have to be clear and we have to stick to them. Thank you. Thank you very much, Elias. Thank you for your interesting input. So, in fact, interest rate hikes could have a permanent component due to the debt level of the United States, and this might also affect sustainability with negative effects for the region. However, you shared a positive lesson for the region, and that is that our monetary policy frameworks are clear. And this has led to a timely intervention of monetary authorities. I believe that this is something that we should highlight, but of course, we have to be able to sustain this over time, no doubt about it. Let us now move to Peru. So, Adrian, what can you tell us about Peru? Going forward, we believe that we might expect some additional supply shocks as a result of El Nino phenomenon. During the pandemic, it was hard to tell whether the situation was just temporary or not, or whether inflation was high just temporarily. Inflation went through many deviations since then, so now we have to be very careful when it comes to disclosing our inflation expectations. None of us wants to have low interest rates if that might cause inflation rates to go back up, because in that case, the interest rate adjustments, in order to be credible once again, should be even higher. As Elias mentioned, I believe that there's plenty of uncertainty as to where interest rates will end up eventually. If we look back to the recent past, rates have been pretty low, but that may change overnight. And there are some factors that may indicate that rates might be pushed up. Therefore, we must always be very cautious when it comes to interest rates and any related measures coming from the central banks. Thank you very much, Adrian. In fact, I believe that taking a cautious approach has been positive. Interest rates were increased in the region before than in other advanced economies. I believe that we were cautious in increasing rates, and we should also apply a cautious approach in the current uncertain context due to supply shocks, but also with a view to the final interest rates. Now, let me go to Alejandrina. Thank you. Okay, this is our annual inflation forecast. And this is our guidance going forward. We believe that inflation will continue to slide down. This turn is due to a reduction of the shocks as a result of the Ukraine war. These shocks were mainly due to the imbalance between supply and demand in the global context, and in the case of demand from the United States was particularly important in Mexico. We had some bottlenecks in supplying goods. We were able to observe some inflation rate reduction, and we expect this to remain. There was also some shock coming from international food prices due to the Ukraine war. These prices have now tempered, even though they have not yet reached pre-pandemic levels, but they have recovered if we take into account the starting point of the war in Ukraine. So this, as far as monetary policy is concerned at an international level, and also in Mexico, we believe that disinflation will continue. Inflation should reach 3% in the second quarter of 2025 in the case of Mexico. That's our target. Now, in the current context or complex context we are discussing, we keep our forecast of a risk balance for inflation that has an upward bias. And let me talk about the persistence of core inflation that remains high. And in connection with such sharp shocks and widespread and everlasting shocks, or the fact that we have been amidst this complex environment for 3 years running, shows that inflation remains persistent compared to the period prior to the pandemic. Then cost pressures. We are worried about the cost pressure. This might be due to FX increases. We have talked about market volatility, also market sensitivity. Over the past months, we have observed foreign exchange volatility affecting the Mexican peso against the dollar. At any rate, this year's levels are lower compared to last year, and this has contributed to reducing inflation rates. Cost pressure continues to come from the price of inputs. There have been some political disruptions, not only at a domestic level, but also internationally. We might also expect climate change effects. We are also worried about the pressure that could have on inflation or the labor market pressure. We recovered more slowly compared to other countries, but now our recovery is speeding up. Our labor market has shown itself to be strong, but that might also be affected by cost pressures. Our economy has been growing lately due to foreign factors such as the resiliency of the US economy and also due to other dynamic aspects. And therefore, this upturn in the economy could also push inflation up in our country. I would classify these risks as our inflationary forecast. However, I don't want to lose sight of the challenges that we face after the pandemic. We have not yet fully understood the structural changes that this pandemic might bring about. For example, we don't know what implications the pandemic may have had on the capital, on the human capital, on our country's productivity. And on a more positive note, I should say that the pandemic forced us to become more digital. And thanks to digitalization, now we are able to hold this online webinar. This could have positive implications for our productivity levels, but we still need to deep dive into the effects that the pandemic could trigger from a more structural perspective. Then we have what we call parallel changes or shocks, that is to say, events that have occurred in parallel with the pandemic. And I'm thinking specifically about geopolitical tensions that have transpired during the post-pandemic period and that have led to relocalization that might affect efficiency in global production. We have to analyze the consequences thereof. In the particular case of Mexico, this might entail an opportunity. We have to see whether we could harness such an opportunity and the challenges of doing so in order to boost productivity in the country. And then we have the pending challenges. So here, thinking about all the concerns we had before the pandemic, and that somehow we had to leave aside in order to focus on the pandemic. However, we should not neglect these challenges because some of them are becoming increasingly more evident. For example, climate change concerns, biodiversity concerns, our inflationary scenario, and our monetary policy. So let me stop here. Thank you very much, Alejandrina. I think that we can summarize some challenges. First off, there's plenty of uncertainty as to the structural changes arising from the pandemic recovery and all the shocks you described. So this creates uncertainty when it comes to establishing product gaps. We have uncertainty as to the natural interest rate that we might expect. So that is a roadblock, no doubt, when establishing in the current changing context what might happen between supply and demand and the trajectory that rates should take in order to go back to normal in the future. So another conclusion in connection with Elias' arguments has to do with financial stability. This mismatch that we observe in interest rate normalization as a result of the US context that might lead to financial volatility, and it might eventually affect the performance of our own domestic financial systems. So it's been a very interesting panel. Now we have some time for questions from the audience. And the first question has to do with Hernando's comments. What is the main risk if there's a mismatch between the Fed's interest rate policies and the approach we take in our economies? Well, I believe that Elias provided a very complete answer. I would say that this mismatch is a natural effect. We actually stepped ahead of the Fed with regard to inflationary shocks. Rates in our countries come down before those in the US, and I believe that that is a natural development. So this is part of our monetary policy pass-through. As Elias pointed out, the mismatch per se does not pose a risk. However, the fiscal policy in the United States might affect interest rates, leading to FX volatility and affecting therefore our own rates. But that would be part of a natural process. As for financial shocks, I would like to make a comment. This is very important. So volatility can have some effects in the operation of financial markets, for example, public debt bonds. But that's one thing. Now, the stability of the overall financial system is another story. The first situation already happened. So we can do nothing, or we can do everything we can in order to stabilize markets in case of surplus liquidity. But we have to know when and how we are going to step in, what kind of intervention we're going to do. Of course, during the pandemic, all the markets were at a standstill, and therefore we had to step in order to make them work. In Colombia, we experienced plenty of volatility, and we therefore had to carry out a more gradual intervention. We were asked to make the most of the pandemic, sending clear signs to the market. As for financial stability, the system should be strong and regulated so that financial clients and brokers can absorb the FX volatility without jeopardizing their financial exposures. So this could enable us to reduce the impact that this could have on the local FX rate. Okay, thank you very much. Hernando, you have referred to something that we learned in the region, and that is the strength of our banking systems. Up until now, or over the past decades, and of course, the pandemic was affected by high volatility and such. But so far, we don't see how that has translated into systemic effects in our banking system. Therefore, I believe that is very important because it shows the macroprudential approach that has been taken in managing the banking system, and the fact that intervention had to be done on a timely basis without actually performing over in intervention or excessive intervention, and therefore having a moral issue. Here's another question. Do you think that the risks of a second round will continue to persist in your economies? Adrian, what can you share with us in this respect? So inflation has not been beaten yet, not fully, as inflation rates show. Perhaps this first quarter might be a little bit complex due to supply and demand shocks, and therefore we need to pay attention to that. But I believe that now risks are fewer. There has been a reduction in inflation rates, but we should not actually neglect the possibility of a second round impact concerning inflation. Does anybody else have any comments on this? Alejandrina, Elias, Adrian, Fernando? Okay. As Alejandrina pointed out, the fact that inflation rate is so far away from the target rate might affect expectations and might lead to complex indexation markets and might require more efforts in order to reduce inflation. Okay, thank you very much, Hernando. We have one final question. I believe that some of you have already mentioned this. Which are the main lessons learned in terms of monetary policy during the pandemic? Alejandrina, would you like to start? Thank you. Well, rather than learning lessons, I believe that we have reminded of the actions we have to take all the time in order to be strong enough and be ready to face any complex situation. We had never thought that situations were going to be so tough. Now, with regard to the technical aspects, I believe that this has been a good reminder of the importance of flexibility and innovation. We had to analyze the context, and we had to be flexible in using tools in maintaining an open mind. We also had to be innovative in order to gather the information we required, or in order to have the tools that we require to conduct a useful analysis to keep our boards well informed. Now, from a macro standpoint, I would like to underscore the frameworks that we have put in place, that each country represented here has put in place. The sound role played by central banks as well in controlling inflation rates. And also because we have been learning over the past decades about the importance of keeping robust frameworks. We have spoken about the importance of having flexible foreign exchange rates. This has also been relevant, and having a fiscal policy in going in the right direction, as well as a resilient, well-capitalized market in order to address these shocks and having sound public accounts. This is something that you do not achieve overnight. It's something that you build over the years. This is what we have been doing in the region. And this is something that you have to do every day. It's like your health. You have to look after your health every day. The same applies here. Authorities in our central banks have to keep on delivering on our mandate. We have also learned that this is macroeconomic soundness is not enough in order to increase productivity across our countries. And I'm saying this because productivity is not only about growth. This has implications with regard to our monetary policy. Therefore, our countries, in the case of Mexico, we should also reinforce our macroeconomic framework, market competition, free entry of enterprises, providing good quality inputs, and the rule of law in order to have clear-cut rules, clear-cut ownership, private ownership rules, private contracts, etc. All that has direct implications to managing our monetary policies. And of course, we always the ultimate goal of benefiting society at large. Thank you very much, Alejandrina. In fact, we have macroeconomic frameworks that are important apart from our fiscal and monetary policies. And all these aspects have been instrumental to maintaining macroeconomic stability in the region. This is, of course, a sine qua non requirement, but perhaps is not sufficient in order to make our economies grow. Elias and Adrian, would you like to add any comments to the lessons learned? Yes, I would like to apologize because I believe that I have run ahead of myself and I answered some questions ahead of time. But let me go back to what Adrian said. We central bankers tend to extrapolate the recent past. And I believe that in the current context, we expect some kind of normal regression. There are two forces here that are making themselves evident more and more. We will have to change our concept of normality. I think that there's one that is quite clear, the other one that is not so clear. One has to do with the impact of climate change in our region. The Central Bank of Chile hosted an annual meeting on climate change a few weeks ago, and we had a representative from the IDB, Mr. Avalo, and he gave us some heads up about a report they are preparing that has to do with the fiscal implications and the shocks in the climate change shocks affecting or striking the region in terms of droughts or floods, etc. Even though we are talking about temporary developments, every time these phenomena occur, they leave behind increased debt. We have to start quantifying that, and I believe that this EDB report will provide us with some numbers, specific numbers. We also begin to see some evidence. We speak a lot about geopolitics. No doubt geopolitics has been impaired, but what are the implications of geopolitics? We know that geopolitics affects trade or financial performance. There's this strange correlation showing that perhaps that's something else. What about the war component of these two new axes? That is kind of a strange correlation. And since the Ukraine and Russia war and what has happened with Israel and Hamas, there have been some countries that have not condemned those developments. So are we talking about a geopolitical trade bloc only, or there's something else? These two aspects share some common implications. Perhaps we are entering a world with higher fiscal pressures due to climate change expenditure and also due to an arms race. So I believe that these are perhaps some of the lessons that we have learned. All the same, we had to start thinking out of the box and get ready for that new scenario. Thank you very much, Elias. In fact, there's a lot of uncertainty as to the implications that these might have in trade and also in the macroeconomic context. With regard to climate change at CAF, we have been working on this subject matter and we have observed that, in fact, these episodes, extreme episodes, are happening ever more often, leading to fiscal implications that might particularly strike vulnerable regions or countries that are not resilient enough in order to counterweight those shocks. And this might eventually lead to unsustainable fiscal policies. Therefore, it's necessary to reduce these risks not only through investment but also through risk mitigation policies, broader climate change risk mitigation policies. There are several measures that can be adopted in this regard. I have no time to discuss them now, but since they have a huge macroeconomic impact as well as a human impact, they should be analyzed. Adrian. I believe that recent economic developments and COVID-19 have taught us a lesson. Before COVID-19, we were used to supply and demand shocks or monetary policy issues or commodity prices issues. Uh, they were business as usual, but perhaps we um, had not experienced issues that were so challenging, such as supply chain disruptions or a war or a pandemic or climate change. I saw this comic saying that, well, there was humanity fighting against COVID, but then we have climate change instead of the pandemic, which means that humanity is faced by something even larger. So repurposing resources and all these changes would certainly become the centerpiece of our discussions in the future. Thank you very much, Adrian. We are coming to the end of our webinar. I believe that it has been a very rich exchange of ideas that have shown that we need to have clear-cut economic policy frameworks in an ever-changing and complex world affected by climate change, by geopolitics, and all the related implications. Therefore, flexibility and innovation are very important, as the pandemic has proven. Therefore, I believe that central banks in the region, we have significant challenges ahead. In closing, I would like to extend my appreciation to Alejandrina, Elias, Hernando, and Adrian for their participation. I would also like to thank Carlos, Flar, and all of our audience for your time. Thank you all, and have a very nice day and Merry Christmas. Thank you.
Muchas gracias.